Welcome back to This Explainer, where we take complex topics, cut through the noise, and break them down so you can truly understand them. So, let's dive right in. When we think about banking, we usually just assume there's this one single, universal rulebook that every financial institution on Earth has to follow. But what if our fundamental assumption about how a bank is supposed to operate is entirely backward?
Seriously, think about it for a second. What if a bank wasn't designed to maximize profit, but instead acted as a public utility, like water or electricity? We are so incredibly used to the standard commercial banking model that we rarely stop to ask if a different framework could even exist. And as you'll see, forcing public banks to play by private banking rules doesn't just hold them back, it literally prevents them from working entirely.
And here is why getting this right is absolutely crucial. Our current regulatory structure is built entirely around private banking. Those private priorities and the inherent conflicts of interest that come with them lead to a system that produces recurring bubbles and crashes every 6 to 7 years. It's essentially a boom and bust cycle built right into the DNA of the standard model.
The root of the problem is where these rules actually come from. Most banking regulations were written by, and frankly for, private banks. They're heavily influenced by major institutions and the Federal Reserve framework. The key takeaway here is that these rules were absolutely never designed with public banks in mind. Public banks operate on fundamentally different principles, so logically, their regulatory structure has to reflect that difference.
Section 1. The Public Utility Model, the Bank of North Dakota.
To really grasp how a public bank functions in the real world, we have to look at the Bank of North Dakota, or BND. It is the absolute clearest example of this alternative model in action, boasting more than a century of safety, profitability, and extreme resilience. And here's the secret to its structure. It has never been regulated by the state banking board. Instead, it regulates itself through its own statute. By being overseen by 3 elected officials, managed by a dedicated president and staff, and advised by an external board, it steps completely outside that standard private banking regulatory loop. Now, you might be wondering, wouldn't a state-run utility bank just be some sluggish, unprofitable, bureaucratic nightmare? Well, consider this incredible metric: 19.3%. That is the Bank of North Dakota's average return on equity over the past 24 years. This completely shatters the myth. It proves that the public utility model isn't just a nice, theoretical idea, it is incredibly, consistently profitable.
So how do they actually pull off those massive returns? It really comes down to stripping away the heavy costs of standard retail banking. Because BND treats banking as a public utility rather than a profit-maximizing machine, their overhead is unbelievably low. We're talking no huge advertising budgets, no expensive branch buildings on every corner, no ATMs to maintain. They pay moderate fair salaries and charge absolutely no commissions or hidden fees. They aren't burning cash trying to compete for your personal checking account. They are operating as a super lean financial engine for the entire state. And this lean structure directly feeds into a completely different lending strategy. It's a night-and-day difference. While standard private banks often focus heavily on speculative purchases, pumping money into existing real estate or shuffling stocks around, BND engages strictly in what's called productive lending. They lend solely to build things, supporting industry, commerce, and agriculture.
This creates a massive, tangible local impact. BND keeps the money in-state, lending only within North Dakota, which means they actually know their borrowers and can monitor them effectively. But even more fascinating is their partnership lending. Instead of acting like a corporate behemoth crushing local banks and credit unions, BND partners with them on these productive loans. During economic crises, BND will actually step in and purchase troubled loans from community banks just to keep those local banks solvent. They act as a stabilizer for the community, not a competitor.
Section 2. The regulatory mismatch.
Okay, so if the Bank of North Dakota model is wildly successful, why aren't we seeing public banks popping up everywhere? Well, the answer lies in how we regulate them. And I know exactly what some of you are probably yelling at your screens right now. You're thinking, what about the risk? Wait, no FDIC insurance? Because in standard banking, a lack of federal deposit insurance is a massive flashing red flag.
To understand why a public bank actually doesn't need FDIC insurance, we first need to define a really critical economic concept: counter-cyclical lending. All this means is expanding lending during economic downturns, precisely when private banks are panicking and pulling their money out of the market. A public bank is specifically designed to step on the gas and help the local economy when times get tough. But here's the catch. Standard FDIC capital rules strictly restrict a bank's ability to do this. The reality is, lacking FDIC membership is not a weakness for a public bank. For one, FDIC insurance caps out at $250,000, which is basically pocket change for a bank handling massive state funds. More importantly, BND literally cannot experience a bank run. Why? Because the state itself is its primary depositor. All state deposits are held at BND, keeping public money in state to recycle into local lending. Subjecting them to standard FDIC capital rules would do nothing but prevent them from executing the exact counter-cyclical lending the economy desperately needs during a downturn.
And the exact same logic applies to collateral. Standard private rules demand that public deposits be 100% collateralized to protect against conflicts of interest between the bank and the depositor. But for a public bank, there is no conflict of interest. The state is essentially holding its own money and guaranteeing its own deposits. Forcing a public bank to have a 100% collateral requirement would make launching the bank impossibly, prohibitively costly for absolutely no logical reason.
Section 3. Funding a public bank.
So if we're not tying ourselves down with restrictive private rules, how do you actually start one of these banks? It turns out there are entirely viable methods of capital formation for public banks using things the state already has: revenue bonds, general obligation bonds, pension funds, and pooled funds. This is how you launch without relying on restrictive debt. On the flip side, we have those restrictive private requirements we just talked about: FDIC membership and 100% collateral. To put this in perspective, California's AB 857 Public Bank Initiative failed specifically because it stripped away these viable options and forced those restrictive private requirements, effectively blocking public bank formation ever since.
The Bank of North Dakota sidestepped all of that. It was launched practically using bonds. And this provides an immediate public benefit. Because they are structured properly, the bank can lend to the state at a low interest rate, refinance state bonds, and generate revenue for the state from day one. They don't have to wait years and years for a traditional startup bank model to finally become profitable.
Which brings us to an incredibly powerful conclusion. Subjecting a public bank to private banking rules would cripple or prevent its creation. The statutory exemptions that the Bank of North Dakota operates under are not sneaky loopholes. They are the essential defining features of a public bank that make it safer, leaner, and more stable than a private bank.
Section 4. A tailored framework. Now, to be clear, taking away private rules doesn't mean having a Wild West with no rules at all. Strong regulation is absolutely necessary. But public banks must be governed by statutes tailored to their specific mission and structure. Furthermore, if you really think about it, private banking boards should actually look at public banks and adopt their productive lending rules. Doing so could drastically reduce or maybe even eliminate those recurring boom-bust cycles that constantly destabilize our whole financial system.
So I'm going to leave you with this final question to chew on. Should public money really be governed by private banking rules? When we break it all down, we see that breaking away from the standard private playbook isn't reckless at all. It might actually be the smartest, most resilient way to build a thriving local economy. Thank you so much for joining me on this explainer, and remember to always keep questioning the frameworks around you.